Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and of course, crystal ball gazing in that order. Today is Wednesday, January 8th, 2025. Today's episode begins with ADP employment and initial jobless claims. Heading over to marketwatch.com, ADP employment came out lower than the expected. Remember, expected is the middle. Last reading of this is the right, and the actual for this read is on the left, and that came in a little lower than expected. Also, initial jobless claims coming out lower than expected. Remember, this initial jobless claims is for the last week, which was essentially a holiday week, and some people are wondering if people that would have made their initial jobless claims last week will do so this week, and that we'll get a jump in that for the next reading of this. But any way that you look at it, we don't have that spike evident yet. Next item on the agenda, something I haven't brought up in a while. It's finally starting to show some interesting movement, interesting development. The 10-year break-even inflation rate moving higher. I have been mentioning for a while how since really October of 2024, we've been sort of in this tight range going sideways, and it was actually yesterday and today with some follow through breaking to the upside, now expecting 2.4% inflation rate averaging over the next 10 years is being priced into this market. And this market is probably the best place to see most accurately what the market is pricing inflation to be at, for 10 years, and I'll say it again, and I said it before and I'll say it again, as much as there's a lot of voices out there saying, well, ringing the alarm bell saying, the U.S. has so much debt that inflation is just going to take off to the upside. This market isn't believing that yet, although it is breaking higher. There is a little more nuance to this. It's something to definitely keep an eye on, though. If this continues higher and higher and higher, that certainly goes against my macro view that inflation will not be so high. And yeah, it's hard to, it's funny thinking about these things and trying your best to not view everything with confirmation bias and to see things as they are. And if I'm just going to take that perspective alone, yeah, we are pricing in higher inflation as it stands today and yesterday anyway. What will really affect this in the short term more than anything is next week's CPI reports, because that's the actual inflation rate of what's going on right now. And so that could continue this higher, keep it steady where it is, or go the other way. Certainly something to keep an eye on. I'm going to add notably to this chart, when we zoom out to the max view on the Fred website, I just want to mention that during the great financial crisis, we going into it, we were at a inflation break-even rate of 2.2%, and we headed higher with a higher high and a higher low, and then a final peak all the way at 2.5% before dropping precipitously in the great financial crisis to 0.11%. Amazing how this break-even inflation rate, that you can have that happen. You can have literally the whole market pricing inflation over the next 10 years to average 2.5%, and only a few short months later dropping to 0.11% being priced in, and then obviously bouncing way the heck back. That speaks more, by the way, to they weren't really pricing in 0.11% into break-even inflation rate. It's more of an effect of volatility in bonds, really. But the main point I'm trying to bring up here is that you can have a recession and the break-even inflation rate rising during the beginning of the recession, which, maybe that's where we are. as much as this adds a little bit of fear to, my bond position. I bought more TMF, by the way, again today. I'm maintaining 57, 58% long duration. But as much as this adds a little bit of fear to my case, it's like, every other signal out there says to me that we're like right in front of the storm here. But we'll see. Remember, I'm just a guy with a crystal ball. Importantly, next item on the agenda, Thursday, tomorrow, markets are closed. This is about respect for Jimmy Carter, president that died very recently. That's why we had initial jobless claims come out today instead of tomorrow. Also, huge report Friday. It could be a kicker. It could be a big kicker one way or another. We got the unemployment report coming out on Friday. This is a the most important report for me every month is this one for sure. So all eyes will be on that. Today was really the last trading day before we get that report coming out on Friday, seeing as though Thursday we're closed. So you could, take what happened in markets today as sort of the prep day for this report. The daily reminders are very important items that I believe every single investor out there should be highly aware of. I read through and explain these on macro shows, which I am only going to do from now on when there's major updates. The last update of this was Friday the 13th with a tornado in the ball. Look for that video. It was out a week or two ago. Also, not really any changes to the crystal ball readings. I had in here bear market occurring, and I changed it to developing, as we're not currently in an obvious crash anymore. The day I changed it to occurring was when we had giant red candles all over the place, and so I'm gonna call that developing still. None of the other crystal ball readings changed, nor any major changes in the Robschild portfolio. All of this also I explain in that same macro show. On to the charts, the S&P 500, we're just sort of in limbo here, going sideways. Everyone that watches markets is wondering, is this it? Is this the big head and shoulders top that, spells the end of the S&P 500 for a while? Could Friday's report be the last straw to break the camel's back? Or, is it going to go the other way and, cause markets to go back to all-time highs? With the Cape-Shiller ratio and the PE ratio of the S&P 500 being so high, I fully expect, major volatility here to the downside. But I don't control Mr. Market, and Mr. Market can be a crazy, crazy guy, as we see over and over again through history. The VIX term futures curve is not inverted, but we are notably just like punching up towards that 20 level here, staying somewhat elevated relative to recent history. And again, Friday's a really big report, and this is the way I see a lot of markets. The way they act the last trading day before an employment report is they kind of find their middle ground to okay, we agree to disagree, and then see what happens with the report and the reaction to it. TLT. You might be sick of hearing me say this, but it's still my favorite place to be. I am surprised at how low this is getting. We got down, the 85.42 level today. On an adjusted basis for dividends, we are hitting close to that low in April of 2024. How low can you go? I don't know. I really don't know. The 20-year bond yield has been hitting its head like exactly at the 5% level. Obviously, that's a pretty big like psychological level for individual retail investors and institutional and investors and foreign governments too invested in the dollar. That 5% is like, I mean, it's attractive. It's the US dollar. I mean, like, I'm buying it here, and I'm sure I'm not alone. I'm just trying to figure out who's selling. TNX, the 10-year Treasury note yield, is another chart to be highly in tune with regarding what can happen to the price of long duration bonds and longer yields. And I was thinking yesterday, maybe, I thought I had found a great parallel channel from this bottom to this bottom. If you drag that up to this top here, like I thought there would be more resistance here. I didn't expect to close above it. But this counts as a breakout candle of this pattern. We're going to want to see a closing daily candle above the high of the breakout candle, 4.7, in order to confirm that we may go higher. Again, we might have a double top going back to April of 2024. Some people are still thinking that the 10-year will actually rise all the way to the 5% level. I will note, though, today that although this green candle in TLT, it looks lower, from it closed yesterday at the bottom of this red candle, and a green candle, you open at the bottom and you close at the top. That's what makes it green. So TLT actually went up today, while TNX rose. The 10-year yield rose, and obviously like I said, the 20-year bond yield, I don't have that chart up, but that actually went down today. And so that 5% level is just seeming attractive to people, like I said, to myself and obviously many other people. Might as well pull up the U.S. Treasury yield curve. This is what I'm talking about here. The 20-year, it's also higher than the 30-year. The 30-year is still 4.9, and yeah, we're at 4, by how this chart reads it, we're at 4.97 today on the 20-year, and it's the highest across the entire curve. And so this is finally getting a little bit of a bid, while the 10-year is rising to it a little bit. The 10-year note yield tends to follow the price of oil, and so when oil goes up, it's almost like clockwork. The 10-year note yield goes up, and when the price of oil goes down, the 10-year note yield tends to follow it down. Today, we have an engulfing candle of either 3 or 4 trading days. This is a bearish reversal candle on crude oil, suggesting that, hey, this could potentially be a top in the price of oil, and if yields are to follow, maybe this is the top of yields as well. So one cool thing about TradingView is these little buttons down here are neat, because you click on them and it tells you the latest stories on what's going on with oil. And today's, if you click on it, you can see that inventories fell less than expected, and so there's more oil out there than people thought, even though supplies are being tightened. So even though the oil producers are turning off the pumps and saying, oh guys, we're not going to make enough money, we better stop making so much oil so we can keep the price higher, despite that, oil reserves are not dropping as much as people expected. And what does that mean? It means people are using oil less and less and less. That's a telltale sign that things are slowing down. When the price of oil drops, it's like, yeah, that's just lower economic activity. That's lower energy being used. And this is a worldwide market, I suspect, with my crystal ball and all, we may be rolling over to the downside in oil. Meanwhile, Dr. Copper, with a PhD in economics, I said I want to see a closing candle above yesterday's breakout candle from this previous Head and Shoulders top. you know, I said we tested it, we got rejected, we got a solid closing below. It looked really bearish with super high probability. And what does Mr. Market do? What does Dr. Copper do? We go up for 1, 2, 3, 4, 5 days in a row, just like, you know, just pausing here and having a not just a breakout, but a large breakout to the upside. In my book, this negates this head and shoulders top move. So we can delete the neckline, we can delete the head and shoulders top, and I mean, you know, maybe we could take a look at this on a weekly candle basis. There are swing traders and people that look at patterns using weekly long candles. For this long of a period, I think I'll stick with the daily. You know, it doesn't matter. I'm not trading it anyway. But I just find it very, very interesting and notable for copper getting a big bid here. Part of this involves the value of the dollar, inflation, all these kinds of things. Although the dollar went higher today, DXY, so there's a bit of a divergence there. But you know, this involves you know, what's going to happen with the tariffs, the tariff war, you know, what's going to happen? What are we going to do? Are we going to collapse the US currency, or are we going to, you know, collapse world markets? I mean, it's like something's got to give at some point, you know, and we'll see what happens. But also a huge thing with copper is what's going on with China. China's a humongous consumer of copper, and whatever markets think is going on over there affects the price of copper greatly. But any way you put it, it's notable that it's moving higher. And that's all from me and my crystal ball. I won't be doing a show tomorrow, rather, because markets are closed tomorrow, and I'll see you on Friday. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching. See you next time. Rob's Child.